is that I'll be asking questions. Yeah, some people are already dropping in the class. Confidence, yes. When you hear the word assurance, a promise, that's good. Sekina said the screen is blank. Please, people, others, can you confirm if the material is still being shared? Please, I need all of us to be on one page, on the same page. Hello, can you see the screen that is being shared? Okay, okay, it's visible now. So, like I was saying, assurance, somebody has typed in the chat that it means confidence, a promise. That's fine, that's fine. Any other person, what comes to your mind when you hear assurance? I'm sure some of us must have heard the song by the popular musician Assurance. So some people say assurance is car. But in this class, what comes to your mind when you hear the word assurance? What are we talking about as regards audit? Any other person before I give you my own take on what assurance is? I'm still waiting, oh, and don't keep me waiting. Okay, Kelechi has typed having hope that something good will come out of a thing. Wow, that's a detailed explanation. This is when they say explain this. That's what you've done. So he said having is it a guarantee? And I said you are not far from the point. That's that. So let me give you my own take on what we mean when we say assurance as it relates to audit and assurance. Anytime in audit, when you hear the word assurance, what we are talking about is what is called comfort, having comfort. So, assurance in audit means that there is a comfort over a thing. That's why all of us are right to an extent. The person that is saying, is it a guarantee? Meaning that you're having a like standing as a guarantor for something. And the person that said is confidence. That means you have confidence in a thing. And the other person say having hope that will, something good will come out of something. So all of us have idea, which is not bad. But in audit, assurance means comfort over a thing. So there is a with like in your accounting, we have a body that regulates the practice of audit all over the world. And that body defines audit. Now, I will explain assurance later, but let me first define audit. Define audit as independent examination of whether accounting principle, accounting system is an independent examination and the expression of opinion on financial statement of a business entity, whether that entity has complied with applicable statutory and professional requirement. Now, that's audit. Now, why do we have audit? That's the question that brings assurance into play. Why do auditors do their work? What's the reason for audit? Because the reason for audit is that people who call in audit, they want to have comfort that what has been done right. I'm using layman explanation now. So when you say audit and assurance, it means that the work of the auditor to come and examine a transaction, examine an accounting system, and to pass opinion that this financial statement that has been prepared by a business entity is fine. That process of passing opinion or that opinion that is being expressed is what is called assurance. So assurance give comfort to people who own the business. So the objective of an auditor, the main reason why an auditor is coming, or the objective of an audit, why we have an audit, is that auditors should come in to pass opinion on the financial statement of the entity, that this financial statement has been prepared in line with applicable financial framework. So when you are talking about audit, you are not just doing audit for the sake of audit. Oh, let's come and do audit. A lot of us know what audit is. They are coming to find what is not lost. They are coming to find what is missing. Auditing itself has a purpose. Is not just is a means to an end. And the end is that audit brings assurance. So when auditors come into a company or an entity or they want to carry out audit work, the purpose is that the objective is to for the auditor to be able to tell the owners of the business that the financial statement that has been prepared by the management, whether that financial statement shows a true and fair view or not, and that financial statement has been prepared in line with the acceptable financial framework. Now, if you look at that explanation, what the audit is trying to do is to give assurance. So, audit in itself brings assurance to owners of business. So, the objective of audit is the auditor passing an opinion. Please, we will be repeating this over and over throughout this course. And I must say this here, when we are talking about audit and assurance, and when you pass this level and you get to the professional class, and you are taking your advanced audit and assurance, the focus of audit here is not your internal audit. Even though we'll still look at the topic that cover internal audit, the focus of the audit we are talking about here is on external audit and external auditor. So all that we will be saying, the concept we'll be explaining, the principle we'll be discussing is as it relates to external audit. Are we together? Now, what is external audit? If you look at the definition of the International Audit and Assurance Standard Board, they define audit as independent examination. Now, that word independent examination means that the person that is carrying out audit or that is doing the examination is independent of the people who have prepared the financial statement. And that's what differentiates internal auditors from external auditors, because internal auditors are also employee of the company. So their independence is subjective to an extent. So the focus of audit and assurance is on external audit. Now, having said all of this, and having stated it here that the objective of audit is to give assurance, and the objective of audit in how do this assurance come about is when the auditor express opinion on the financial statement. Now, there are two things that I want you to keep in mind here. The work of an auditor is not to come and discover whether there is fraud or theft in an organization. Somebody is typing here. Is anything being shared? I can't see anything. Please, others, can you still see my screen? I'm sharing the material, and I've also sent it to the WhatsApp group. So please confirm you can still see my screen. You can type, you can just unmute and let me know if you can still see my screen. Please, it's very important that the screen is being shared. Hello, can anyone still see my screen, please? Let's just give me that assurance here.
It's just the folder that is visible, the folder where you save the document. The document itself is not open.
Oh, okay. Let me reshare. I lost connection at a point, so I guess that's why. But once you see it now, let me just know. I'm coming now. Okay. Okay. Can you see the screen now? Please let
Yes.
me know.
Thank you very much.
Okay, that's good. So, like I was saying, assurance is all about the auditor giving opinion. Now, the major work of the auditor, like I was saying, is not to detect whether there is a fraud in an organization, or whether there is theft, or whether they have enough inventory, or all of that. The major work of an auditor is to express opinion on the financial statement, whether or not that financial statement shows a true and fair view, and whether or not the financial statement has been prepared according to applicable financial framework. Now, what that means is that when the auditor is coming in, don't forget external auditor in this, his work is on analyzing and carrying out examination of the financial statement that has been prepared by management. So all the work of the auditor, that, oh, where are the source document, where are the invoice, all the question and every audit procedure is carrying out, is to confirm the items in the financial statement, their completeness, their appropriateness, the recording. For instance, if you take the inventory aspect of the financial statement, maybe the value on the inventory on the financial statement is 2 million. The auditor wants to determine that that inventory actually exists, whether that inventory has been recognized in line with the acceptable financial framework, which in this context is IFRS, whether that inventory has been aged appropriately, how is it measured, how is it recognized. So all the auditor is doing is to pass opinion on financial statement. Having said it, it doesn't mean that the auditor might not detect fraud in the course of their work. It's very, very possible. A thorough audit will reveal if there is theft or fraud, but that's not the primary work of an auditor. The work of an auditor, the objective of the audit is that he wants to pass opinion on financial statement, and is passing this opinion so that this financial statement has been prepared according to financial framework. Now, what are these financial framework? I believe some of you will be taking financial reporting. Am I right? So you have your IFRS, you have your IAS. These are accounting standard that guides the preparation of financial statement. Under your IAS and your IFRS, we have about five types of financial statement, which have different standard that speaks to how they should be prepared. The line item in the financial statement, how they should be recognized, your PPE, how do you calculate it, your depreciation. So when the auditor comes in, is checking for all of that, because that's what will give the auditor avenue to pass an opinion. Are we together? If you have questions, don't hesitate to let me know. You can also type or just stop me. So that's why audit goes along with assurance. That's why it's important for the auditor, before he express opinion on the financial statement, to have appropriate and sufficient evidence to back his opinion. Now, why do we say it's an opinion? It's an opinion because the auditors will only do sampling on some selected transactions up to a degree. The auditor will use what we call materiality. And before I go into that, why do we need auditors? That's the question that some people you need to answer. Why is this course important? Why do entity call in for auditors? Why should the opinion of the auditor on the financial statement count? And that will lead us to the concept that is called here accountability, stewardship, and agency. Now, the reason why we need audit, if you look at large companies, companies like your MTN, the banks, GTB, Access Bank, companies like Dangote, large quoted companies, oftentimes these companies are owned by separate people, which we call shareholders. Now, these shareholders, they own the company, they put in the capitals. Sometimes we call them investors. They invest in a certain business. But the management and the running of the company is not done by these shareholders. So we have another group of people that do the day-to-day running of the companies, that manage the operations of the company. These are your directors, the executive management. These are the people that you will see that goes to the come to the workplace every day to carry out the activities of this company. Now, if you as a person, you are a shareholder in MTN, obviously you don't know anything about telecoms. Let's just assume maybe you don't even have any certification in telecoms, but you have quite a number of shares in MTN. Now you are an owner of MTN, but you need directors and executive management vis-a-vis all the employees of that company to manage your business. And that's why auditors come into the equation. Why? Because the owners of the business are usually different from the people running the business. So at the end of the day, when directors finish their work, they will prepare what is called financial statement. Now, your financial statement that you're studying in financial reporting, your your statement of financial position, statement of profit and loss, changes in equity, all of that is being prepared by management. Now, what that financial statement is doing is to give a view of the statement of affair of the company. And when I say statement of affair, is to show to the owners of the business that, see, this is how your business is performing. This is the position of your business. This is what your business is achieving based on all the assets that you've invested in this business. That's why if you look at your statement of financial position, for instance, you have the asset side and you have the liability side and the equity side. Like we all know, the equity side shows the investment into the business. The assets are what you are using to run the business. The liability are what you hold, your obligations to people, to entity, and all of that. Now, when directors and management prepare this financial statement, the owners of the business, the shareholders in this case, they need comfort, they need confidence, and that's where the assurance is coming in, that what has been prepared by the directors, this financial statement, is the true state of affairs of the company. And that's why we call in the auditors to come and verify and give us comfort that this financial statement is prepared in line with acceptable financial framework. This financial statement is showing a true and fair view of the statement of the company. Any questions so far from what I've explained to us? Any question? Okay, no questions. Now, based on that concept that I've explained, that auditors come in to give comfort to the owners of the business. So the concept of accountability is saying that the directors, the executive management who prepare the financial statement, they are accountable to the owners of the business. That's the shareholder. So the concept of accountability is saying that directors, executive management, they have responsibility. They have to like give a report to the owners of business that this is how we've been using your asset to, this is what is happening. So it's more like a report. But that report will not hold if there is no independent party to review it. And why the shareholder cannot just take their word for it is because accountability comes in. Now, when we say stewardship, in stewardship is more like a role of you employ somebody to manage your affair. More like what you see, maybe a small business owner now, you get an apprentice and you leave the shop to the person to manage. So that's more or less like still explaining the relationship between the directors and the owners of the business. The directors are steward for the owners, the shareholder. So they are in a position of stewardship. Their role is a stewardship role. And stewardship means like you've been given right to manage a certain entity or manage an asset to look after them for the owners. So that's what we mean by stewardship. I hope a lot of all of us on this call are in the WhatsApp group, because I've also dropped the material on the WhatsApp group for us to follow through. So let me know if you've seen it there. So, like I was explaining, stewardship. Then the third concept to explain the need for auditors, because all these concepts, they make you understand why audit and auditors are important. Take for instance the accountability. We say that the management, the directors are accountable to shareholders, so they prepare financial statement. Now that financial statement that is being prepared, for it to make sense or for the shareholders to believe it, they call in the auditors. If it's in the case of stewardship, they've given asset to the directors to manage. They are the steward in this case. Now, how do you determine whether the company is doing well? Is it just because they've prepared financial statement, they've done all the IFRS? The auditor comes to give comfort, comes to give assurance to the shareholders. So that's how the auditor comes in. The same thing for the principle of agency. In the principle of agency, there is one party that is called an agent, who who is having a duty of responsibility to act in the interest of the principal. So the agency principal has a party called principal, and the other one is the agent. So the agent is acting on behalf of the principal. Now, agent will do everything as if it's the principal that is doing it. So shareholders are the owners of the company, but you see director behaving as if they are the owners of the company. Is allowed based on the principle of agency. Directors can fire, they can hire, they can even make investment decision for the company. They can decide to go and set operations here and there. They will do everything practically as if they are the owners of the business. That's the principle of agency. They are because the principal has given them that right, and it is expected in the principle that the agent must always act in the best interest of the principal. So all that the executive directors and the management are doing, all they are doing for the company, they hire, they decide to sell branches and all of that. It is assumed that they are doing it in the best interest of the principal. But how would the principal know that these things are actually in my best interest? That's where the auditors comes in. Any questions so far? I hope the material is still being shared. Please, in case you're not seeing the material, let me know, because I think my network is acting funny here. So please
It's not
just
being
let.
shared.
It's not being shared. Okay, I guess as
Yeah.
much. Okay, let me because it's if you have it on your phone too, no problem. Because I think the network is also affecting the sharing sometimes. Um, okay, okay, okay. So, okay, is it on now? Just let me know if
It
it's
is,
on
yes.
now. Okay.
Yes, it is.
So that concept of accountability, stewardship, and agency, it gives us an idea, more light into why the auditor is needed, or why the role of the auditor is very important. So in an exam, if you are asked to explain the concept of accountability, once you know what it entails, you end it with why auditors come into this mess. I hope that is clear. Now, quickly, let's look at the role of materiality concept in all of this. Now, when auditors carry out their audit, one thing you must know is that auditors cannot test all transactions, because it's not possible. So what auditors will do, take for instance a company that is into operations where they make production of items into their millions. They have the finished product into millions. or their operation is in 100 million capacity. What the auditor will need to do, will need to set what we call materiality. Now, materiality is a concept that gives the auditor kind of based on the materiality that this is these are um, areas of importance. These are areas that I need to pay attention to based on the risk involved, based on the value of the transactions. So materiality concept is very, very important in audit. It gives the auditor a guide. Now, in setting materiality, the auditor will look at transactions, look at the company, look at the size of the company. That okay, if this transaction is omitted from the financial statement, or if this is misstated, will it affect the decision of the users of this financial statement? Don't forget, auditor wants to pass opinion on financial statement so that that opinions can give comfort to shareholders. So when auditor is looking at financial statement and setting materiality, the auditor must pay attention to those entity, those those transactions that, if in the light of the company's operation, if these things are misstated means that if they are in error, or if there is error around it, if they are not stated accurately, will it affect the decisions of the shareholder who rely on this financial statement? So that's what the auditors look at when it's setting materiality. So that's very important for audit. You must have a materiality threshold, you must set it. Now, don't forget, when I started this class, I said we started with looking at assurance. What's the meaning of assurance? How do you relate assurance to audit? Now, there is what we call assurance engagement in audit. In this subject, rather, assurance engagement. Now, what assurance engagement is telling us is that these are type of engagement that entity carries out or entity involving. Now, what is assurance engagement? I've explained what assurance is: giving comfort, giving giving a kind of confidence, like somebody wrote in the chat, to the shareholder. So, what is assurance engagement? Is audit an assurance engagement? What do we mean when we say assurance engagement? Now, there is a definition of, or a way I will explain it so that when you are in exam, you can easily remember. Now, anytime you hear the word assurance engagement, what assurance engagement is saying is that any engagement at all, any engagement in any assurance engagement, there is a practitioner who has been engaged or employed by one party to pass opinion on a piece of information that has been prepared by another party. So, what I will take it again. In any assurance engagement, a practitioner has been engaged to pass opinion on the piece of information that has been prepared by another party. Now that's the definition that is easy to remember. You can write it down. In any assurance engagement, a practitioner has been engaged by one party to pass opinion on the piece of information that has been prepared by another party. There are many definitions of assurance engagement, but that definition I just gave you is the simplest. There is no ambiguity about it. Is any engagement at all where there is a practitioner, that practitioner has been engaged by a party to come and pass opinion on a piece of information that has been prepared by another party. Now, let's look at that definition and look at the International Audit and Assurance Standard Board definition. In IASB definition, they said assurance engagement means engagement in which a practitioner express a conclusion designed to enhance the degree of confidence of the intended user other than the responsible party about the outcome of the evaluation or measurement of a subject matter against a criteria. Now, the definition is very rich and very robust, but at the same time, student can mix it up. So that's why that other definition I gave you is acceptable, is an ICANN definition. If you look at that definition against this, they are saying the same thing, and I will explain it further. If you look at that first definition, some of you must have written it down. I expect that you have your jotter and your pen and you jot down as necessary. In that first definition, I said that in any assurance engagement, there is a practitioner who has been engaged by one party to express opinion on a piece of information that has been prepared by another party. Now, the practitioner in this definition, if you look at this definition, engagement in which a practitioner express a conclusion. So this conclusion that is the practitioner is expressing is the opinion in the other definition. Now, why, like I've explained earlier, shareholder comfortable that the people they've given asset to are doing the right thing. So that conclusion designed to enhance the degree of confidence is the opinion in the other definition. Now, the intended user here is the party that has engaged this practitioner. Your intended user is the same thing as shareholder, while the responsible party is the person that prepare the piece of information. So assurance engagement means that there must be an opinion that is being expressed. And for you to express that opinion, you must have criteria for analyzing your opinion. So if you look at the objective of audit that I said in the first paragraph, that the objective of the audit is that the auditor express opinion whether or not financial statement has been prepared in line with applicable financial framework. So when management prepare financial statement, for instance, it is expected that they prepare it in line with accounting standard and the legislation that is operational in that country. So take for instance, in Nigeria, if you are preparing financial statement, it is expected that financial statements are prepared in line with IFRS and the IAS. And not only that, financial statements should also prepare in line with the legislation that is operational for that industry. Take for instance, in the banking industry, we have CBN regulations that guide banking activities. So there is a company law that speaks to bank. When you are preparing financial statement, there are some expectations that should be there. If you are in manufacturing, there is a CAMA 2020 CAC law that speaks to how some financial statement. Take for instance, Dangote Group of Company. Dangote has a refinery, that's a petroleum industry. And Dangote also have Dangote Cement, that's manufacturing industry. There are some company laws that is specific to petroleum industry. So in the preparing of financial statement for Dangote Refinery, apart from your IFRS, there are some expectations that should be there. So when the auditor comes in, the criteria for analyzing the financial statement to express opinion is your standard and the legislation of that land. So when you look at assurance engagement, there are five key elements that must be in an engagement for we to say this is an assurance engagement. So if these five elements are not in any engagement at all, you can't say it's an assurance engagement. It's very, very important that these five elements must be present. So it is called the elements of assurance engagement. And this is a common question in ICANN. Discuss and explain the elements of assurance engagement. You must write the five, and it's sequential, meaning that the first one precedes the second one, the second one precedes the third one precedes the fourth one, and the fourth one precedes the fifth one. Now, what are these five elements of assurance engagement? The first thing in any assurance engagement, if you say this is an assurance engagement, the first thing you are looking out for is that there must be a three-party relationship, meaning that there must be three persons involved in any assurance engagement. Now, let's go back to the definition I gave you. I said in any assurance engagement, a practitioner has been engaged by one party to express opinion on piece of information prepared by another party. And that one party that engaged the practitioner is those are the people who want to use the opinion. These are the intended users. The practitioner is in if we are taking audit, for example, the practitioner is the auditor. The intended user, the one party that engaged the auditor, is the shareholder. The responsible party, which is another party that prepares the information, these are management. So these three sets of people must be present in any assurance engagement. So if it's just two group of people you can see in an engagement, that's not an assurance engagement. Take for instance the relationship between management and employee. Maybe you have an head of finance and he's asking tax manager that he should prepare a tax schedule that they want to submit. That does not involve three persons. So once you can't see these three group of people, you can't say it's an assurance engagement. And it's not just any three group of people. They have their role. The practitioner is the one looking at the work of another person. He's not examining his work. So the auditor is not the one that prepared the financial statement. Is the management. So the management is the responsible party. So any assurance engagement that the the practitioner is reviewing the work of another person, and that practitioner the opinion expressed by the auditor, that's what we must look out for. Now, I've taken my time to explain this because it's very important that you understand that there must be a three-party relationship before you can say that this is an assurance engagement. Now, if this three-party relationship exists, can we just stop there and say it's an assurance engagement? No. The second thing that must be present, which is the second element of any assurance engagement, is that there must be a subject matter. There must be a subject matter. Now, if you take the case of the external audit, a subject matter in this case is the financial statement that is being analyzed to pass opinion. So when the auditor is a practitioner, is engaged by the intended user, the shareholder, and the auditor wants to pass opinion on the financial statement. That financial statement is the subject matter. The financial statement that has been prepared by management, that's the matter to look at. So assurance engagement must have a piece of information. In that definition that I gave you, the piece of information is the subject matter, which is usually financial statement when if it's an audit. Another example of assurance engagement that we can look at, there are some big companies that they have a tax department. They have tax manager, they have tax officers. Now, this tax manager, they prepare the tax schedule. But these companies, they will still engage the service of tax consultant to come and look at the tax schedule that has been prepared before they do their filing or before they make payment. Now, if you look at that relationship, management in that case, they are the one who wants to use the tax schedule. They are the one that employ tax consultant. But the preparation of the tax schedule is done by the tax department. So we can say that's a form of assurance engagement because there are three people involved in that relation in that engagement. Tax consultant, which is an independent person, is not a staff of that company. the management that engaged the tax consultant, the tax department that prepared the tax schedule. So in that case, we can say the subject matter for that particular uh, engagement is the tax schedule. Just like your audit, financial statement is the subject matter. Now, if there exists a subject matter, is there all there is, and we say there is, that's an assurance engagement? No, there must be the next third element, and that's the criteria. Now, criteria is what is explained in the objective of an audit. We said that the objective of an audit or the auditor is to express opinion on the financial statement, whether it shows a true and fair view, and that the financial statement has been prepared with applicable financial framework. Now, applicable financial framework is your standard, the legislation of the country for preparing that financial statement. So the criteria in this case means the standard that you use to prepare the financial statement. So if an auditor is examining financial statement, the suitable criteria in this instance is your IFRS. So what basis is this financial statement prepared? Are standard being followed? What is the accounting policies of this company? Is it being followed? So there must be a suitable criteria in any assurance engagement. Any questions so far? Don't forget, if you have questions, you just let me know because I might not be following the chat. So if you have the suitable criteria, the fourth important element of assurance engagement is your evidence. Now, in audit, if there is no evidence, there is no audit. Audit is all about evidence. So it means that as the auditor wants to express opinion on the financial statement, there must be evidence to back the opinion that is being expressed. So take for instance, an auditor is saying that this financial statement does not show a true and fair view. Where are the evidence that speaks to that? So that's why when an auditor comes into an entity, they are asking for evidence. Excuse me, they are asking for evidence. They are asking, oh, where is the invoice to support this transaction? Where is the supporting documents for this? Where is the book of record? Where is the approval? Where are the minutes of meeting? All those things that the auditor is asking for is to serve as evidence to back the opinion that is being expressed. Oh, you said that our accounting policy is this. Where is it documented? That's why you see auditors, they like documented evidence. And there are two things auditors always do when they are gathering evidence. The evidence must be sufficient. So sufficiency of evidence speaks to evidence must be enough. There must be enough evidence to back a particular matter. So that's one. Then two, the evidence must be appropriate. When you say appropriate evidence, you are talking about the criteria of evidence are very, very important. That the evidence must be sufficient and it must also be what? Appropriate. Because if it's not appropriate, the auditors cannot rely on it. So auditors are not just getting evidence for the sake of it, they are getting sufficient and appropriate evidence. So that's the fourth element of this assurance engagement. I'll go back to it. The first element that must be in any assurance engagement is there must be three-party relationship, existence of three-party relationship. And this three-party relationship is that there must be a practitioner, there must be the responsible party. The responsible party is the person that prepares the information to be reviewed by the practitioner. And there must be the intended user, who are the people that will take this opinion of the auditor, for instance. That's like your shareholder who wants to use this financial statement. So there must be that relationship in any in any assurance engagement. Then the second element that must be present in any assurance engagement is what is called subject matter. What are we looking at? What's the piece of information that you are passing opinion on? What is that thing that the auditor is reviewing? We say in any audit, the subject matter is financial statement. If it's the relationship between tax consultant, management, and tax department, it is your tax schedule. There must be a subject matter. Then if it's the next element is there must be suitable criteria. In an audit, subject matter is the financial statement. But what criteria, how is the financial statement prepared? So your standard, your IAS, your IFRS forms the criteria for that assurance engagement. Then we said there must be evidence, and the evidence must be sufficient and appropriate. Now, before we go to the last one, is there any question? Is there any question? If there is no question, that means I can continue. Are we together? Please let me know. At this point, I feel I should ask a question.
Yes, we are here.
Okay, so I can call your name if I want. So let me just Alexa. Alexa, are you there? Okay, it seems Alexa is not here. Sekinat, are you there? Let me know.
Yes, I'm here.
Okay, so that we are on one page. What do you understand by
Yes, sir.
the principle of agency? Can if we are giving a question in an exam, explain the principle of agency as it relates to audit and assurance or in audit and assurance. You started the class with us. So can you just do that in a minute? What can
Agency
you say?
principle.
You said
Agency principle.
the
The
agency
the
principle.
Okay, do you want
the
to go
direct.
first, Alexa?
Okay.
Yeah, you can go
Mm.
first.
Okay, any
Okay.
one of you
So
can go.
in the agency principle, the directors is act as an agent of the shareholder, which is the owner of the business.
Okay,
The right to fire, the hire, and also decision making to it. And the director also is accountable and responsible to prepare a report
okay,
through financial statement, which is due to the shareholders, and the shareholders also uh, employ or bring the third party person, which is the external auditor, to check up the whatever financial report prepared by these executives, to give
okay,
the comfort to these shareholders or
okay,
assurance.
okay. Thank you very
Yes.
much. Yeah, you're right. So the principal agency speaks to the relationship between an agent and a principal. The agent acts in best interest for the principal. Now, the agent act as if is the principal because the principal has given the agent the right to act on his behalf. So when you look at that principle and apply it to the relationship between directors and shareholder, the director acts as agent for the shareholders and they have right to take decisions on behalf of the principal, which is the shareholders in this case. That's why directors and executive management decide who to hire, who to fire, where to make investment decision for the company. Most time people even forget that the directors are not the owners of the business. But because in the the principle of agency, the principal, which is the shareholder, has given them power to act on their behalf. And it is expected in the principal agency that an agent must act in the best interest of the principal. So to determine whether the agent is acting in the interest of the principal, the auditors Alexa, what can you say about materiality concept? Why is materiality concept very important in audit?
Materiality concept is
Let
indicator that
Sekinat
you
answer that. Sorry, Alexa.
ah
Thank you. Sekinat. I can't see Sekinat here. Can anybody try saying those that started the class with us before we go on? Anybody? Okay, I can see Miriam here. Can you want to give it? Can you give it a try? What do you understand by the concept, materiality concept? Why
Okay.
is it important?
All right. So to start with, the concept of materiality means that an information is material if omission or misstatement of financial information can influence the decision of users.
Okay, that's
So
very key.
an auditor cannot review all the financial transactions. They must sample.
Okay,
So
okay,
so which means that they must look for information that is material in terms of value of the transactions and the risk involved.
okay. Thank
Yeah.
you very much. You said the key thing there. In materiality concept, the auditor must look at every information and in deciding what is material, these are the two key things he must look at. Whether the omission or misstatement of that item will influence the decisions of the users of the financial statement is very, very important. You know that the financial statement, we've said it over and over that shareholders need comfort over it. So if the auditor doesn't set the right materiality, it means that shareholders will be making decisions on an uninformed or ill-prepared financial statement. Yeah, thank you for that. So we'll continue. Now, we are talking about assurance engagement. We are talking about assurance engagement. And we've been explaining the elements of assurance engagement. And I've explained that for it to be an assurance engagement, there must be 5 elements. That if these 5 elements are not present, you can't say that this is an assurance engagement. There must be a three-party relationship, there must be the subject matter, there must be the suitable criteria, there must be evidence, which the evidence must not only just be evident, it must be sufficient and it must be appropriate. And now the last thing is that there must be report. Now, the report is very, very important. It's very, very key that after an assurance engagement, a report is to be prepared. There is a topic in this class which we will look at towards the end of the class. Report. What is the audit report about? How is it being prepared? What are the requirements or the expectations that must be in the audit report? I've said that the objective of an auditor or an audit is that an opinion is being passed on financial statement. That opinion that the auditor wants to express is expressed in the audit report. So the assurance that the auditor wants to give to the shareholder, it will be documented and expressed in a written report. So if the financial statement, for instance, is not showing a true and fair view, the auditor will state it in the report. And there is a paragraph in every audit report that is called basis of opinion. So under that paragraph, the auditor will state the reason why the financial statement is not showing a true and fair view. It will be expressed in that report. So these are the five elements that must be in every assurance engagement. I'll quickly go over it again. Three-party relationship must be present. There must be the subject matter. What is it that is being reviewed, or what is the practitioner going to examine? There must be the suitable criteria for examining that subject matter. If it's a relationship of an engagement of audit, the financial statement is the subject matter. The standard for preparing financial statement, the legislation of that country. Take for instance in US. US doesn't use IFRS. They have a GAAP system. So, and they have their own company law too. Every company has company law. And in most countries these days, statutory audit, which is a form of audit that is backed by law, is a must for every listed and quoted companies. When we say listed and quoted companies, these are companies on stock exchange of any country. So once your country and your company is quoted, or a listed company, or a public liability company, it is expected that you carry out annual audit. That evidence must be sufficient to back the opinion that is being expressed, and the evidence must also be relevant. That's what appropriate speaks to. So these two things must always be present in any evidence that the auditor is looking at. Then we said that after you have your evidence, there must be a written report. Written is report is where you see the assurance. So the expression of opinion is done in the written report, and that's where the assurance is being provided. Now, there are two types of assurance engagement. There is a type that is called assertion-based engagement, and there is one that is called direct report engagement. Now, I'll just quickly explain it. Assertion-based engagement, these are the type of engagement where the responsible party and the subject matter, they are making assertion based on what. In an assertion-based engagement, the evaluation or measure of subject matter is performed by a responsible party, and the subject matter is a form of assertion. So this type of engagement will still, let me just say it here. You see all these concepts that I'm laying out here, we are still going to look at them as a topic. So there is a topic in your syllabus that speaks to assurance engagement, audit related services. So, but this first topic is more like introduction. So when we talk about this assurance engagement, we are still going to look at what is the practitioner going to do, all of that in detail, the subject matter and all of that. Even the audit report, we will still look at it. Now, I said something about audit report is where you express opinion. What are the types of opinion that we have? So when you take an audit report, if an auditor says that this financial statement does not show a true and fair view, or an auditor says that the financial statement shows a true and fair view, what type of assurance is that? What type of opinion is that? So there are two main type of opinions that the auditor can give in any audit report. Two main types, or there are generally two levels of assurance that you can have. We have the type of assurance level that is called reasonable level of assurance, and we have the one that is called limited level of assurance. So we'll look at these two types: reasonable level of assurance and limited level of assurance. Now, based on these two types of assurance, the users or the intended user of the or those who engage the practitioner for the assurance engagement, they can now make their decisions. They must know the type of opinion that the auditor is giving. When we said something about materiality, we said auditors cannot carry out 100% testings of all transactions. It's not possible. So auditor will use audit samplings, they will do materiality just to arrive at this opinion that is being expressed. Now, if they are not testing all of the transactions and they express opinion, how can you as an intended user rely on that opinion? You must know the type of opinion that is being expressed. You must know the type of opinion that is being expressed before you can make decisions. So that's why the two types of assurance level is very, very important. Is important. Now let's quickly look at them. I'll explain. The first level of assurance, the first type, which is called reasonable level of assurance, is that type that is called an high level of assurance. Why is it called an high level? This is type of assurance that is expressed when the work that is being done is more. There is more transaction testing, there is more audit exercise that is carried out. And the reason why is we say is high is because in this type of assurance, the auditor will do more work. The auditor will do more work. The kind of procedures that is performed for reasonable level of assurance is higher than the type that is performed in a limited level of assurance. In limited level of assurance, the procedure performed are very few and they are moderate. And the expression of opinion under limited level of assurance is in a negative form. We'll look at the example. The type of assurance that is expressed in reasonable is called a positive form. Now, when we say positive form, what do we mean? And when we say negative form, what do we mean? Now, I want you to pay attention here. I'll ask a question now, and I want any persons to try and answer. If not, and I'll ask that you tell me the difference between these two type of sentences. Now, I want you to listen carefully. Are we together? Now, if the auditor express this type of opinion, or what is the difference between these two statements? The first statement is this. I hope we are listening. In the financial statement, in our opinion, this is how it started. In our opinion, the financial statement shows a true and fair view. Listen to it again. In our opinion, the financial statement shows a true and fair view. I hope we get that. Now, the second statement is this. Nothing has come to our attention to show that the financial statement does not show a true and fair view. Nothing has come to our attention to show that the financial statement does not show a true and fair view. Let me take it again. The first one says, in our opinion, the financial statement shows a true and fair view. While the second one says that nothing has come to our attention that causes us to believe that the financial statement does not show a true and fair view. So who can tell me the difference between the two? I'll take it again. The first one says, in our opinion, the financial statement shows a true and fair view. While the second one says, nothing has come to our attention that causes us to believe that the financial statement does not show a true and fair view. Who can tell me the difference between the two? Anybody? Ogechi Ona, are you there? Ogechi, are you there?
I'm here, sir.
Okay. Now, I hope you heard the statements.
Yes, I did.
Okay, so what's the difference between the two?
Okay, so the first statement, the report was written with confidence and it gives an assurance that they've done due diligence, they've checked all what is expected of them, and they are very certain that the report is true and fair. While
Okay.
the second statement proves that they have done a little. However, there is still possibility that if more work is being done or more documents are being reviewed, there's every possibility that they could still find something that will prove that the report they have is not true and fair. So
Wow.
it's a bit not, there's no confidence in the second report.
Thank
And
you.
yeah.
So you really, really explain it. So if I may ask, don't go away yet. Don't go away yet. You've really explained it, which is very,
Hello, sir.
very. Hello.
Hello, sir.
Yeah, I can hear you.
Okay. Considering the two statements, the one you're
Okay.
talking about right now, the
Okay.
first one really shows that the auditor has done a good job. Like
Okay.
he has done much research more than the
Okay.
second statement. And the first one shows that it gives a kind of positive assertion or positive report that,
Okay.
how will I put it? Like a positive opinion,
Okay.
an opinion that is given with confidence that he has done much research
Okay.
and is confident about the work done, being the
Okay.
first one. Why the second one, where he said nothing has come to our
Oh.
attention that causes us,
Mm-hmm.
it means he has done some job, but he's not confident about the quantity of job or research that he has done. So this last one is giving a kind of negative opinion. Let me put it
Okay.
that way.
So which one will you
Concerning
say is a limited level of assurance?
the limited is the second one, which says that nothing has come to
Okay,
our attention.
you are right. So that's what I'm trying to explain. Now, there's something Ogechi said. He said that in the second one, they are giving a disclaimer that, oh, we've done so much, but if we have had opportunity, we will have done more. Now, that is a limited level of assurance. So what it speaks to is that when you are expressing an opinion that is limited level of assurance, it shows that you have not done enough procedure to come to the conclusion that this financial statement does not show a true and fair view. And that's why in an audit, it is expected that the opinion you give is a reasonable level of assurance. Audit is a form of assurance engagement, but how be it, the opinion that is expressed in an audit should be reasonable because it is expected that in an audit you must do enough procedure as required. That's why one of the things that when an auditor is coming into a place, there is a topic we'll be looking in some weeks to come. Obtaining an audit engagement. It's when an auditor is seeking or about to take up a new engagement, there is an engagement letter. One of the things that will be stated there is that the auditor must have access to all books of record. The auditor must be provided with enough information that it requires, and the auditor must be given free access to check and document and all of that. So when is an audit is being carried out, it is expected that the auditor must do as much as possible required by audit standard. So when you look at your ISA, we'll still talk about ISA very soon, International Standard on Audit. There are expectations on the audit work, on the auditors. There is a requirement that the auditors must fulfill before he expresses his opinion. And that's why the audit opinion is always a reasonable level of opinion, is an high opinion. It is expected that you've done enough. But when you are carrying out an assurance engagement that is not an audit, take for instance, there are different form of assurance engagement apart from audit. It could be a corporate social responsibility report, an environmental report, a sustainability report, report on the activities of the company in OSEC environment. You might not have access to all that you require. You might not carry out enough control testing or test of control. So thereby it means that you have not been provided with all that you're supposed to do, or you've done only few procedures. So you will express an opinion that is in a form of negative. That's why that one is saying that nothing has come to our attention that will cause us to say that the financial statement does not show a true and fair view. It's very important that you know these differences because that's what the examiner will test. Now, quickly, let's go on from there. Now, based on that reasonable level and limited level of assurance, let's quickly look at why. Now, there is something I must say before we go on. Actually, in practice or in reality, now this is what you have when it comes to opinion. You can either have a reasonable level of assurance or a limited level of assurance. But when you look at the type of assurance we can have, We actually have three. And the third one, which is not attainable, is what is called absolute level of assurance. Absolute level of assurance means that you are 100% certain. 100% certain because you have tested all transactions. Take for instance, if I'm expressing an opinion, instead of saying in our opinion, the financial statement shows a true and fair view, I won't say in our opinion, I will say we are confident that the financial statement shows a true and fair view. That's an absolute level of assurance. But we cannot have that. Why we can't have that is that it is impossible for auditors to test all transactions. So quickly, we have these reasons for why we cannot have absolute level of assurance. Now, the examiner might want to play with you and say, we have two types of level of assurance. We have a reasonable level of assurance. We have limited level of assurance. But why can't we have absolute level of assurance? Now, these are the five reasons why you can't have absolute level of assurance. Number one, the lack of precision are often associated with subject matter. Now, what do we mean when we say the lack of precision? Financial statements, even though it's expected that financial statements should have no misstatement or little or no misstatement, that financial statements should be prepared and the items should speak to what they are. So if you say you have this value for your PP, you should have it on ground, that there should be completeness, there should be accuracy, there should be existence, and all of those assertions in preparation of financial statement. It still doesn't mean that the financial statement is 100% accurate. Why is that? Because financial statement preparation sometimes comes with estimation. It comes with estimation. Take for instance, if we are talking about liability in financial statement, maybe provision for liability, contingent liability. These are estimates. If you are talking even about depreciation, depreciation is a form of estimate. So it means that financial statements are not 100% accurate. So even if auditor test all transactions, the fact that financial statements have a form of estimate around them means that we can't have absolute level of assurance. So the first reason why we can't have absolute level of assurance is lack of precision, often associated with the subject matter. So if you are doing any assurance engagement and the subject matter has subjectivity around it, that will mean that you can't have absolute level of assurance. And that's why in your exam, ICANN test and your accounting test, you will always see that the focus is on the two types and the limited level of assurance. Now, the second reason why we can't have absolute level of assurance is because the nature and timing of audit procedure. Now, audit procedures usually, how do you carry out audit procedures? Audits are usually an annual thing, meaning that the auditors will come in usually at the end of the year or middle of the year if there's going to be an interim audit, and the auditor will be looking at carrying out test of control, substantive testing at a point in time. The audit is carried out usually at a point in time, not all the time. So it means that the audit procedure is testing event that has happened. Sometimes this event happen in January and the auditor is coming in November. So it means that you can't be too sure about the audit procedure giving us the real result of what happened at that point in time. Sometimes they will present just source document. We purchased this generator for so, and all you need to back that the purchases is an invoice. What if that the generator is not purchased and you are being given a false documentation? Even though audit procedure seeks to be accurate as much as possible, but because of the nature and the timing and the extent of procedure you will carry out, we've said it that auditors cannot test all transactions. That's No matter how much the audit procedure is robust, there is a limit to it. So that's another reason why you can't have absolute. The third reason why you can't have absolute level of assurance is that most of the evidence you will get, they are not conclusive. Do we mean by this? It means that these evidence are just what they are presenting for the auditor to back what, just like I said, you can't be so sure. It's not that they are definite. So most evidence are subjective, they are persuasive. Auditor will have for minutes of meeting that was held in January, and the auditor will be looking at the decisions they were taking in that minute. Well, how is the auditor certain that that's eventually what transpired in that minute? How sure is the auditor about that minutes of meeting? But the auditor will take that minutes of meeting as an evidence that this decision was arrived at. So that's another reason. Then the fact that most audit or evidence are on a test basis, the auditor is just doing sampling. That's another reason. Then the other one is the completeness problem. You can't be so sure that all items that you've tested is they are so right enough to arrive at that conclusion. So there is the fact that the one you didn't test might be the reason why there is a problem in that entity. I hope we're all clear on this. Now, quickly, just to bring us up to board on the syllabus, we have what we call statutory audit, and I've explained this. But just so that we are together, when you hear the word statutory, what comes to mind? What comes to mind? Anytime you hear the word statutory means that backed by law, legal requirement. And I've said it earlier that statutory audit is now a compulsory audit for all listed companies. So in most countries today, it is expected that public companies and large companies should carry out annual audit. So that annual audit that is being carried out is what is called statutory audit. And the company law that's in Nigeria, which is CAMA 2020. CAMA 2020 is Company Allied Matters. So what that is saying is that how should the statutory audit be carried out? Who is exempted from audit? Now, the fact that a company is listed does not mean that that company should also have an audit. A company might be a small company. Now, when a company is small, most time when you have small company, it usually means that the owners and those managing the company are one entity. But the fact that a company is small and is exempted from audit doesn't mean that anytime a company is small, it should be exempted from audit. No, the company law states the criteria for exempting a small company from an audit. So you can say you are a small company, but if you are a listed company and you say you are small, do you fulfill this criteria? Because the law is saying that if you are small, you must have this criteria. If you don't have this criteria, you're not a small company. So what are those criteria that will require exemption for small company? The first thing is that for a company to be exempted from audit based on the fact that the company is claiming that it's small, the law is saying that one, the company must not have carried out businesses since corporation. So if you look at the Company Act, like I would like you guys to read this up. There are about 5 or 6 conditions for exemption of it for defining a small company. So if you meet this definition of a small company, you will be exempted from audit. Number one, you must be a private company. So if you are a private company, we will say you are small. Number two, your turnover must not be more than 120 million. So what we are saying is that for you to say you are a small company, one, you must be a private company. Your turnover must not be 120 million at a point in time. Once it's more than that, you are no more a small company. Now, the second thing is that if you are a private company, your turnover is not more than 120. At the same time, your net asset value must not be more than 60 million at any point in time as determined by the commission. So if this year your turnover is less than 60 company, we will say you are small. But if next year your turnover exceeds that, you are no more small. Then the fourth thing for you to qualify as a small company is that none of your member must be an alien. That means the members who are the owners of the company must not be a foreigner. Once you have a foreigner in your midst, then you are no longer a small company. The other criteria for fulfilling a small company is that none of your member must be a government or government corporation or agency. So it means that the owners of the company should not be a government parastatals. So you can't have NNPC, for instance, as one of your shareholder and you are claiming small company. No, it's not allowed. Then the last is that the share capital of the directors, all that the director hold as the share capital, must not must at least be 51% of the equity capital. So if all of you as the director you have share, you must have at least 51% of the share capital for you to say you are small company. So if you have less than that and there are other shareholders, you are not share company, you are not a small company. Now the reason for this definition of small company is that so that companies that qualify for audit will know them, because audit comes with a cost. Audit is expensive. If you are a listed company and you don't do your annual audit, you will be fined. So, and apart from that, the audit comes, you have to pay the auditors and all of that. So it means that companies might want to claim that we are small so that they don't have this statutory audit. So that's the reason why the law specify what is a small company. So quickly, let's look at what qualifies someone to act as an external auditor. Now, we've been talking about external auditor, external auditor, external auditor. And I said that this course, the focus is on external audit. So who can act as external auditor? Now, the fact that you are in this class, you're preparing for exam, you're in skill level, and you pass this skill level, you move to the next level, the professional, and you now qualify as a chartered accountant. Does that make you an auditor? Are all chartered accountant auditors? No. So for you to act as an auditor, we have two criteria that must be fulfilled before you can act as an auditor. The number one is called self-regulation by the audit profession, while the second one is called eligibility to act as an auditor based on the regulation by government. So there is regulation by government and there is self-regulation by the audit profession. So these are the two criteria that must be fulfilled before you can act as an auditor. Now we'll look at them. The first one, self-regulation by audit profession. It means that before you can act as an auditor, there is the audit body that gives license. Now, ICANN is such. There is a regulatory body. The audit profession has a regulatory body that determine who and who can act as auditor. The fact that you get chartered and qualify and become a chartered accountant does not mean you can act as an auditor. If you want to become an external auditor, ICANN has requirement that you will fulfill apart from your qualification as chartered accountant, whereby they will not issue a license for you to act as an auditor. So there is a self-regulatory body called ICANN. Every country has it. The profession has come together and form a professional body that will be responsible for determining who acts as an auditor. Why is this necessary? It's necessary that there is a body guiding the activities of auditors so that nobody will just come up and say, I'm an auditor. I can, and auditors are very, very important because we've explained it under uh, the confidentiality, accountability, stewardship rule, the difference between owners of company and those managing the company. The fact that auditors want to give assurance, they want to express opinion on financial statement. So anybody cannot just do that work. So the audit profession has a professional body, ICANN in Nigeria, that regulates and determine who qualify to act as an auditor. The reason why is necessary so that the audit that is performed are done by fit and proper person, because there are expectations on auditor. Auditor must be independent. Auditor must have integrity. Auditor must be suitable criteria for determining whether audit financial statements are prepared in line with applicable framework. So to regulate and determine whether auditors are carrying out their work properly, there is need for the audit for a regulatory body. So what self-regulation by the audit profession does is that it determines who and who can act as auditor. It also check on the audit work that is done, whether the work is done appropriately, whether there is application of the appropriate technical standard. So, and it's also determine whether the person that is doing the audit is updating, they have technical competency. It also provides guidelines for how the audit work should be done. But thereby there is a monitoring aspect of the work. Now, when you qualify and you have the license to act as an auditor, over time, periodically, ICANN as a regulatory body will come to you, whether you have an audit firm or you work in an audit firm, they will come and review your work. Okay, they will carry out monitoring exercise, check your audit firm. I have a senior colleague that ICANN last year, they came to the audit firm and they will ask for their audit exercise, ask for their client list, check on whether they are doing the right thing. So what the self-regulatory body is doing is that they want to give members of the public that the auditors are doing their work, because there is a topic we also look under this, whether in this class or in the advanced audit class, that speaks to auditors' liability. Because if auditor express a wrong opinion in their audit report and shareholders rely on that report, and it is found out that the auditors didn't do a thorough job, or there is negligence, or is the audit is not thoroughly done. I said that in audit, the kind of opinion that is being expected is reasonable level of assurance. So if an auditor is giving a false premises and the kind of opinion he didn't do enough work as required, when you give a reasonable level of assurance, it's expected that you've carried out appropriate and as many procedures as required. So if an auditor didn't do that and you express an opinion, and users of financial statement they are relying on that, and it's found out that auditors didn't do a good job, auditors can be sued, and auditors can go to jail for poor work. They can even be fined even if they don't go to jail. We've had cases in Europe, even in Nigeria, where it's found that auditors did a bad job and they have to pay heavily. So the regulatory body ICANN, they need to guide the profession. So they determine who can act, they check on the work, and they set procedure for monitoring and for establishing rules. So that's how the determination of who can act as external auditor. Now, the fact that ICANN act as regulatory body, a country itself can also set up a form of regulation on who can act as auditors. So that's the one we call regulation by government. The government of Nigeria can decide that, for you to qualify as an auditor, apart from the one that the professional body is doing, professional body will give you license to act, professional body will check on your audit work, they will check your competence, they will monitor your work. The government of Nigeria also has its own requirement. You can fulfill the professional one, and if you don't fulfill the government one, you will still not be able to act as an auditor. So it means that the two works together. So the eligibility to act as an auditor will start from the self-regulation by the profession, which is the professional body, and also the regulation by government. So every country will have their own requirement for you to act as an auditor. So what are those things that the government will put in place? The government, if you go to the CAMA 2020, there are three main things that the government have put in place for you to act as an auditor of any company. Section 4031 of CAMA 2020 says that For you to act as an auditor of any company, number one, you cannot be an officer or a servant of that company and you will still be the auditor. So once you are in employment of that company, you're an officer or you're a servant or you're an employee of that company, you cannot be the auditor of that company. And that's why internal audit cannot carry out an audit of the financial statement and the shareholder will say it's good to go. No. Internal auditor employee of the company, so they cannot act as external auditor, because what the government is trying to remove here is independence. We've said it at the beginning that an audit is an independent examination. So for that, that is more or less like registered business. That is, for instance, you are into the production of a certain product, you are registered, you have it registered, and you are also have an audit firm, and you say you are an auditor. Once you have it, you are an entity, a company, you cannot act as an auditor. And that's why auditors, once you're an auditor, you have an audit firm, that's what you're supposed to do. You don't dilly-dally in an audit profession. So these are how determination of audit is determined. Who qualifies to act as an auditor? Now, under the self-regulation, who can act as an auditor based on professional body? We have some things here. How are audit standards set? What's the role of audit standard? In your financial reporting course, you have your IAS, you have your IFRS. IAS speaks to IAS 1, preparation of financial statement, IAS 2, inventory, measurement, recognition, your IFRS 15, revenue contract, and all of that. Now, those are standards that guide accounting work, how you carry out accounting work. Those are the standard for it. It even speaks to how you record all these transactions on financial statement. Now, the same way you have those standards for accounting, we also have auditing standard. Now, these auditing standards are set by International Audit and Assurance Standard Board, which ICANN is a member of. Now, the setting of this standard, they have a process of setting it. Before any ISA, ISA in this instance is called International Standard on Audit. Before they set any new ISA, they will call for body of all auditors that, oh, we want to review a standard similar to what you would do when you are setting up IS. There will be a draft. That draft will be shared with all audit professionals and they will all bring in their comments. Based on their comment, if there is need to be an adjustment will be made. Then when they now agree, it will now be modified and approved and they will issue out the standard. So we have a quite number of ISA. We have ISA 200. It's called ISA, more like an abbreviation. So when you see, and in this class, we will look at some of them. We have ISA 200. We have ISA, which is the objective of an audit. ISA 200 speaks to why should we have an audit. So we have ISA 315, identifying risk in an audit, obtaining. We have quite number of them. Even your audit report has an ISA that guides it. So we'll look at some of the ISAs in this class and we'll also look at in advanced class. Now, is there any questions so far? Okay, somebody said my screen is not showing. Okay, I guess it's the network. The network has been acting funny. Now, I think it should be on now. So there is a way that the standard. Now, this standard are what the auditor will use to determine, to carry out the audit work. The audit work is a regulated work. So when you see an auditor, external auditor coming into any entity, they are not just doing the work anyhow. There is a guide to it. There is what is expected. When we're talking about assurance engagement, we made mention of the elements of assurance, and we said that that evidence has a standard that speaks to it. How you should determine whether evidence is sufficient, whether it's appropriate. There is an ISA that speaks to it. So don't forget, I said that this topic is more like introduction. So we'll still look at all of this in detail. So there is an instance that speaks to that. Then, apart from your audit, because audit in this class is not just only audit we will look at. We also look at other type of engagement. We've introduced assurance engagement. We will look at some engagement. Now, all these engagement also have their standard. Just like we have ISA for audit, International Standard on Audit, we also have International Standard on Quality Control that speaks to other type of engagement. There is International Standard on review engagement, International Standard on assurance engagement, International Standard on review. So all of these standard, auditors needs to be aware of them because it helps the auditors. By the time the auditor is forming his opinion on the financial statement, there won't be any issue of negligence here and there, or you didn't carry out your work. So that's why it's very, very important. Now, if you have questions, let me know before we go on. Any questions? I know that we've had a busy day, and one thing with online class is that it's happening at the in the evening during the week, and I understand that some of us must have been busy, but please bear with us. If you can listen, we also made the recording available so that you can listen to it over again. So if there is no question, I will go on. Now, statutory audit. I've explained that statutory audit is a required uh, audit, annual audit for listed company. What are the advantage of statutory audit? What are the advantage of statutory audit? Now, if you look at when we're discussing concept of accountability stewardship, you can pick the advantage from there. Why this advantage of statutory audit is more like why is audit necessary? Number one advantage is that statutory audit gives credibility to the published financial statement. It increases their credibility. Financial statements are prepared by management for owners of the business, shareholder. Once there is a annual audit that comes to review those financial statements, that financial statement has credibility. And when we talk about credibility, it means that it can be relied upon. So, take for instance, you want to invest in two companies, company A and company B. Company A, both of them has financial statement, but company A usually have statutory audit. While company B, they don't have audit. They will maybe they just do audits every 3 or 4 years or when they feel like. Which one will you have a form of assurance over if you want to invest on? The company A, of course. So statutory audit increase the credibility of financial statement because what that is saying is that it means that that financial statement has been reviewed by an independent person, and that's why most times for listed company you will see them saying audited financial statement. Audited financial statement means that an auditor has reviewed it. Another advantage of statutory audit is that it confirms to management that they have performed their statutory duties correctly. Now, we've said that audit gives assurance to shareholder. The same way audit gives assurance to shareholder is the same way management derives assurance from an audit. For instance, a management has prepared the financial statement and they've done a good job of managing the asset. They've prepared it in line with applicable standard, and an auditor comes in and review that financial statement and express an opinion. What that is saying is that management will be like, we've done our work very well here. So it also gives management an assurance that they've performed their duty correctly. So the shareholders cannot come and say, we want to reduce your bonus, this, that. Because just like the principle of the agency principle, that an agent is acting on the behalf of the principal in best interest. So management can say, I've acted in your best interest. So that's the second advantage. Now, the third advantage is that it also provides assurance to management that they have complied with non-statutory requirements. So there are some industries that have some expectation. Take for instance, there are some industry that is expected that this and this must be done. When an auditor comes in and review and has carried out an auditor, management can say, we've done our requirement. If a company wants to get a credit facility, for instance, and it goes to the bank, I say, I need a certain loan amount, and they present an audited financial statement, is the bank can decide to give that credit because of that audited financial statement, because it shows that an independent party has reviewed their work. So it gives assurance to management. The other advantage is that it's more like a feedback on internal control system. Now we'll still look at internal control as a topic. One thing an auditor must always check when carrying out their audit or expressing opinion on financial statement is that an auditor must check how effective is the internal control in place, because the effectiveness of internal control determine whether financial statement has been prepared very well or whether financial statement shows a true and fair view. If there is a weak internal control system in any organization, it means that the financial statement that is prepared is will not show a true and fair view. What do we mean by weak internal control system? If there is no proper approval for payment, if there is no control to determine whether there are leakages, if there are no internal control to mitigate against theft, and you now prepare a financial statement under that circumstances, how can you say that financial statement is showing a true and fair view? So when an auditor comes in and looks at the internal control, they have what we call management letter, where they will document their findings on internal control. So statutory audit provides feedback whether internal control is effective or not. And that's an advantage of statutory audit. It gives feedback to the management. So what are the disadvantages of statutory audit? For everything that has advantage, there is always a disadvantage. One general and acceptable disadvantage or limitation, when you see limitation in audit class, is the same thing as disadvantage, is that audit is costly. Sometimes audit comes with high cost. Audit fee is not cheap, especially if you are using any of the big four. Now, the big four are worldwide, globally known audit firm. There are big major four audit firm in the that you will see in almost every country. These are your PwC, your KPMG, your EY, and Deloitte. Now, this audit firm, they have a record of carrying out audit over the years. They have reputations, they have expertise, they have coverage, they have staff strength, they have technical know-how. So over time, most companies use their services, especially when a company wants to prove point to investors or to government that they are doing the right thing. They will engage the service of these big four. Now, these big four, their fee are not cheap. Even your medium-sized audit, we have medium-sized audit, BDO, Grant Thorne, and all of that. Their audit fee are also expensive. So that's a disadvantage. Now, if a company is struggling, they are not making profits as they should, and they are still paying high cost because to audit, because it's required that they do that audit, that will speak to their bottom line, their financials. So audit can be expensive. Now, the second disadvantage is that audit can cause disruption to the company staff. If the audit is not well prepared or the company doesn't have uh, good communications with the auditor, it can create disruption to the business of the company. So that can be a disadvantage. Now, the other disadvantage is that the subject matter can be full of estimate. I've said it before that financial statements have estimate in them. If you take a line item in a financial statement, probably like I said earlier, contingent liability or your depreciation, some of these items are estimate and an auditor is passing opinion on that. That's a disadvantage. So some item in financial statement might be estimate, which the fairness and the truth cannot be ascertained. So because this estimate, you can't determine for sure how certain they are. So that is in itself is a disadvantage, and you are expressing opinion on that. And another disadvantage is that when there is a fraud in any company, most time when fraud is going on and the fraud is happening at management level, management can conceal this fraud, and at times statutory audit or audit might not detect this. So because, take for instance, an auditor is in place, there has been a fraud that management is trying to cover up. Of course, they won't make any evidence available just like that to the auditor. So statutory audit might not detect fraud because that is not what statutory audit actually should do. Even though if there is fraud, a good audit should detect it. So most fraud, which include concealing, might not be detected by statutory audit. Then the other disadvantage is that because auditors use sampling, they might it might be very hard for you to totally rely on the opinion of an auditor. We've said it here. Even though an auditor is expressing reasonable level of assurance, the fact that the auditor didn't test all transactions means that that opinion can still be subjective. Let's say the auditor tested 70%. The remaining 30% might be the reason why the company will have problem. So these are some of the disadvantages of statutory audit. And because of these disadvantages, it's still bet the auditor will always tell management that the responsibility for detecting fraud, the responsibility for improving on internal control rests with the management. So it is expected that management owns the responsibility for detecting fraud because of this disadvantage. So I will be asking another question here before we finish. I hope we're still together. Okay. So Raphael, I believe Raphael is a guy. Are you there? Raphael. Raphael, are you there? Okay, while we wait for Raphael. Michael, are you with us? Michael Akinyemi. I need to ask this question so that you understand, and if you have questions, you can ask. But Michael, I have a question for you. Are you with us? Okay. Who is bold enough that wants to answer the question even before hearing the question? Okay, let me ask the question, and anybody who is ready can just like um we said that the eligibility for an auditor has two there are two ways whereby you determine who is eligible to act as an auditor. The first one is self-regulation by the audit profession. That's where the professional body determine who acts as an auditor. Then we said the second one is regulation by the government, where the government has some stated criteria as documented in the company law. Now, under the self-regulation, can you tell me two reasons why the professional body should regulate the audit profession so as to determine who qualifies to us as an audit? Hello.
So
Yeah,
can you repeat
we
the question?
we I
We
think we
can hear
lost you
you.
for a moment.
Okay. But did you hear the question I put up? Adesha?
No, sir, I couldn't hear you.
Okay. So let me give you but you've been listening.
Yes, yes, yes.
Now, under the eligibility to act as auditor, I said we have two ways where we can determine who can act as auditor. What are these two ways? So at least you hear that now. Adeswa.
Yes.
So what's the first way to determine who can act as an auditor?
The
Hello?
hello.
Yeah, we're waiting for
The
you.
the first one is a self regulation
Okay,
by audit
self-regulation
profession.
by
Second
profession,
one
yeah.
is a regulation by government.
Yeah, fantastic. Self-regulation by profession and regulation by government. Now that's a very good one, Alexa. Now anyone else? Uluwapemipo, are you there? Uluwapemipo, are you there? Okay. I think I will give prize to Alexa. She has been very active tonight, and that's good. I like that. I like when students try. This is not the exam, so it's good that you exercise yourself and just put yourself try. Nobody is marking you at this point in time, but when you try it, it sticks. It sticks. So, Oluwapemipo, Augusta, are you with us? Who wants to answer the next question? It's still on the eligibility as auditor. Ogechi, are you with us?
Yes, I'm here.
Okay. Now we've said that there are two ways for determine eligibility as auditor: self-regulation by the professional body and regulation by the government. Under the self-regulation by the professional body, what are those things that the professional body do to ensure that one when the audit profession is preserved? I mentioned it in the class. What are those things that the
Hello, sir.
yeah, Augusta?
Oh, sir.
Yeah, can you
Under the self-regulatory process or method,
yes,
you said something about regulation by continual review of
okay,
maybe certificate, that them being current by going for more certifications,
okay,
like an auditor, go for more certifications to make you current in your field
okay,
under the self-regulatory method.
okay, okay. Then
And
thanks
you
for
also
trying. Okay, I'm
and
listening.
you also made you also made mention of them having the right certificates before they would like maybe from ICANN,
Okay,
apart from being a chartered accountant, that the audit they have this audit organization or audit stuff that review their certificates to know if they are really qualified to be an auditor, despite the fact that they are chartered. It's not enough reason for them to act
okay.
auditors.
Thank you for trying. Thank you, and I appreciate that. So what we
Yeah,
said under this.
can
Okay,
I
somebody else
just say
wants to try.
something?
Yeah, say you're allowed.
Yeah, this is Micah.
Okay,
Um, I feel that apart from having your, apart from being a qualified accountant, the bodies too. See, as an auditor, the body will still have to review your work to see if you're actually doing the right thing, if you are doing it well before you can be qualified to be an external auditor.
okay,
Thank you.
okay. Thank you, Michael. Thank you, Michael. So the self-regulation by professional body, which is self-regulation by the audit profession, is a process where the professional body determines who and who qualify to act as an auditor. And the process is such that, take for instance, Nigeria. ICANN is the self-regulatory body, the professional body that determines who qualify to act as auditor in Nigeria. Now, the fact that you are preparing to become a chartered accountant does not qualify you to act as an auditor. However, after your qualification as a chartered accountant, there are requirements that you have to go through before you will be issued a license to act as an auditor. So the first thing to act as an auditor is that you will be a chartered accountant, and after fulfilling the requirement, you will get a license to act as an auditor. So the professional body ICANN maintain and regulate who and who should act as an auditor. They have list of all registered auditor in the country. And how they do that is that they ensure that apart from those that they've given license to act as an auditor, they are qualified to do the work, they are fit and proper person to do the work, they have the technical competence. So it means that they have require technical competence to act as an auditor. They have audit experience. They understand what it means to act as an auditor. Then two, they also check on their work by ensuring that what they've been doing is in line. So they go about doing this by carrying out monitoring and enforcing compliance on those members. One can be delisted from these registered auditors. So the fact that they've given you license, if they find out that you're not doing a thorough job, they can delist you. You can also be fined, because if it's found that auditors are negligent in their work, is a direct on the audit profession. So the self-regulation is a form of preservation and determination of who act as external auditors. So it's key. And from the text I've shared in the WhatsApp group, please, I will advise that we go over this again and you just familiarize yourself with all those steps. Now, that's for eligibility to act as an auditor based on self-regulation by the audit profession. Now, we also say the government of a country can determine who acts as an auditor. So it's one thing to fulfill the audit profession requirement. It's also another thing to fulfill the requirement by the government. So for the government, their own requirement is documented in the company law, Kama 2020 for Nigeria, which says that for you to act as an auditor, you must not be in the employment of the company, you must not be a body corporate, you must not be a partner to the company. So that's what the government is saying. So all of this is to ensure the independence of the auditor, so that by the time the auditor is expressing his opinion in the audit report, the intended user can rely on it. Is that clear? Is that clear? Now, is there any question? We are gradually coming to the end of the first class. I know that the class has been, though it has been interactive to an extent, which I appreciate, but going forward, I want us to be very much more alert. Then I'll be asking questions. So if you have any question, please let me know before we round up today's class. I hope we've enjoyed the class. Don't worry, this is just the first class. It's to introduce, some of us are familiar with some of these concepts, but it's also to introduce some of the concepts. So, like I said at the beginning of the class, I'll be taking this class in conjunction with the other lecturer. So there will be some Wednesday that I won't be the one taking the class. The other lecturer will be the one. He's equally very good, very sound. He's my senior colleague in the business. So you are in for a good tutorial. And I know by the end of this class, the exam will just be a walkover. So is there still any question? Because we are gradually at the end. So I will give us an assignment. I will give us an assignment. I want us to, if you have your ICANN pack or any other, I want us to go and write on audit related services. I'm giving an assignment now. Audit related services. Now there is, what is the difference between the assignment? This is the question. What is the difference between audit, attestation? What is the difference between audit, attestation, and assurance? I hope we have that question. I will type it in the chat and I'll also type it on the WhatsApp group. So the assignment is, what is the difference between audit, attestation, and assurance? I know I've not mentioned attestation in this class, but I want you to go and do that research. What is the difference? So I'm typing it in the chat. So when we come next, I want us to try this. What is the difference between audit, attestation, and assurance? I hope we have that. So next class, or when
Yes,
next
sir.
I'm come. Okay, so next class or when next I'm coming, I want to see what we've written about this. Is that clear? So this is where we'll be rounding up. I hope you've enjoyed the class, and please, okay, there is Alexa is raising up her hand, so you can go ahead and ask your question. Alexa?
So we mentioned about the types of assurance engagement.
Yeah.
And there are two types. One is the assertion-based engagement, and the other one is direct reporting engagement. I just noticed that the assertion-based is available to intended users, while the second one is not available to intended users. What is the meaning of that one, sir?
Okay. Let me the types of assurance engagement. If you go back to the test, so the assertion-based engagement is the evaluation or measurement of the subject matter performed by the responsible party and the subject matter information in form of an assertion by the reference that is made available to the. So what we are saying is that when there is an assurance engagement where the practitioner review the subject matter and now give it to the intended user, it makes the report available to the intended user. If you look at the structure of the company, we say we have the management who prepare the financial statement, we have the shareholder who engage the auditor. Now, the audit is like a form of the assertion base because the auditor, after carrying out the audit of the financial statement and is now expressing his opinion on that financial statement, he will prepare a report. That audit report is prepared for the intended user. So any assurance engagement where the practitioner finally prepares the report for the user to say, okay, this is what has happened, is assertion based, is more or less trying to assert what the other person have done. It's like, oh, this person that prepared this financial statement, it has been prepared in line. The financial statement is true and fair. Oh, the financial statement is not true and fair. It's like passing a judgment on the work of the responsible party on what has been done. But the other one, direct reporting, in the direct reporting, this type of assurance engagement, you don't prepare report for the intended user. What you do is that the practitioner just perform work on what the responsible party has done and just make his conclusion. But that conclusion or opinion is not given to the intended user. So an audit is not a direct report engagement, even though it's an assurance engagement. A form of direct report engagement, for instance, would be, let's say, in the office, you have a finance manager that reports to head of finance, abi, and the head of finance reports to maybe the CEO. Now, the CEO expect that the head of finance should do the accounting for the organization and everything is fine. Now, the head of finance wants the finance manager to prepare the report. Now, when the finance manager prepares the report, eh, and the head of finance is reviewing that report, if the report is fine, the head of finance just, okay, it's fine. They don't go, sometimes they might not need to go and give that report to the CEO to make decision. It's just from part of the normal report, even though the CEO is aware. So in direct reporting, usually the report is not prepared for the intended user, even though the intended user will now pick it. It's not prepared directly for the intended user. Let's say, let me give you an instance. In audit, the audit report is prepared for the shareholder. So the shareholder makes decision based on it directly. But an investor, a public, who is looking at that financial statement to make report investment, that report is not directly prepared for the investor, but the investor can look at it. So it's a form of report. That's why you see people who invest in companies, stock exchange, they are looking at the financial statement of different companies to make judgment. But that report is not directly prepared for them. It's prepared for the shareholder. So that's a form of direct report that you prepare a report and you've handed it over to a particular person. But who will use it? You don't prepare it available directly for them. But for the assertion base, is made available directly to the intended user, and that's the difference between the two. Does that explain your does that answer your question?
Yes, sir. Thank you.
Okay, thank you. Thank you. Any other question? Any other question? And don't forget the assignment. I hope we have it. It's very important that we do the assignment so that we are all on one page. So this is where we will call it a day. Ideally, the class should be for 2 hours, but I want you guys to just have a taster. So if there is no question, please have a good evening, a good night rest. Good night, everyone. I've also dropped the question on the WhatsApp group. Okay?
Thank you so much, sir.
Thank you, sir.
You're welcome.
Thank you,
All right,
sir.
so see you. Hello, you have a question?
Oh, good night.